Good morning, traders. Good morning, everybody. Good morning, Stel.
Good morning, Vietnam.
Hey, welcome to
How
a
are
new
you, Kay?
one. Yeah, very well, thanks. I hope everybody's okay. Everybody had a good rest over the weekend because it's moving. And so welcome to April. Welcome to a new quarter. Welcome to a new fiscal year in Japan. And the week we are chasing the Easter bunnies. Well, without any further delay, let's start with what shook the markets over weekend. They had the decency to wait until after the first of April's Fool's Day to announce the massive cuts in oil output led by Saudi Arabia. There's been I don't know how much. There's 1.2 million barrels per day cut announced, adding to the 500 that Russia did. And I think there's a couple of others already joining in the fun. So yeah, we opened with a nice little gap on oil last night, trading well above $80. So where they were expected to hold fire for now, they decided, nah, in the 60s, it's a bit cheap, and we don't want the SPR buyers to get an easy job, so let's cut a bit.
Did Biden buy back? Sorry to interrupt. Did Biden buy back the amount they sold?
Not yet. No, because they said it may take months, if not years, to replenish the whole SPR reserves. So they probably had a few there, because they said their buying range would be like around 62 to 70, 62, $68. But no, I don't think they are anywhere near replenishing their reserves.
Yeah. Well, not very good timing, but yeah, okay.
Well, I mean, it should be a very bad timing for risk, but I don't know. It does seem that apart from, well, we had the gap openings, but like for instance, euro-dollar cable already back to the levels we were. Yen opened with a gap lower because of their energy imports, and the rest was pretty. Yeah, the rest is really coming back to levels we saw around the close. The antipodians are even a little bit higher, but we will come back to that. I think some of it may have to do with upcoming RBA and RBNZ. So that for the oil then. So that means that they really want to keep a tight grip on oil prices. Really don't want to let them go down. Of course, there was already reaction from the US side before and afterwards, and they thought it wouldn't have been a good idea to raise them. Of course not, but that's what happens when you show a red flag to a bull, right? They run right into it. So that for the oil story. I don't really. I don't know whether we have like, because there's a few interesting levels here. I don't know if there's really a chance for it, like people say, to go back to $90, but it could be. Yeah? It could well be. So that, what else happened this weekend? So there was not much on the data front over the weekend, but there were a few lines. So the Japanese Foreign Minister Hayashi, he visited China. First time that a Japanese official visited China in 3 years, if I'm correct. So, and they just was really more an exchange of warnings. So the Japanese Foreign Minister warned China, sorry, against more military involvement with Russia. China is also trying to rule the South China Sea now with Malaysia. So there was a bit of an exchange of warnings there. China warned Japan on their semiconductor output restrictions. I'd say not much that we can take away from it. But I saw an interesting line regarding Japan is that they are actually still buying Russian oil, and that is going against what the allies would want them to do. And hold on, my needed to support squawk. Yeah, so that goes a little bit about against what the allies would want them to do, and they're paying above the cap. They're paying above the cap too. So I think combined with the oil news, that may be one of the reasons as well why yen is on the defensive this morning. We'll talk about the new fiscal year in the Bank of Japan a little bit later. Right. In other news, yeah, I saw the RBNZ released some kind of new framework in regards to debt to income, but they haven't enforced it yet. So we're waiting for them to make any decisions on the back of it. But they want to rein in the high debt to income of the New Zealand people. They have done already such in the past. But they seem to be wanting to keep a very tight grip on what's happening in that sector. We also heard from Fed's Waller over the weekend saying that he thinks that inflation can drop without too much harm to the jobs market. He probably doesn't have the numbers yet, but we'll have this famous jobs report coming on Good Friday this week. What a mess that could be, because 3/4 of the market is going to be out. A lot of markets will be closed, and they found it funny or useful to bring the labor report out on a Good Friday. So we'd better be ready on Thursday night and have very limited and controlled risk in the books, because that could really be, yeah, as Brent says, a nightmare scenario. Elsewhere, Australian government won a by-election, so that is, let's say, good for stability. Let's put it that way. There's not much we can really take away from it. I don't think there's the Australian dollar didn't really react too much to it either. It was more like a case of some dollar moves over the weekend and the start of this week. UBS announced that they are going to cut up to 30% of their staff. I let you guess where they will find so much people to lay off. I think it might be it's not a big we don't take a big bet saying that most of those layoffs will be of the Credit Suisse crew. But anyway, they announced that up to 30% staff cuts. Haven't seen anything on any move in the Swiss on the back of it. By the way, this morning the Swiss side deposits came out, and they are showing a decline. So which means that the lending, the borrowing that they did for the Credit Suisse nightmare was a temporary one, and all back to square. Well, maybe not square one, but square 2 and 3, and we'll see if we get back to square one. What else? I didn't see too much other in the hot market news. Some announcements is Macron is to visit China this week, and also von der Leyen is going to China from the 5th to the 7th of April. So they might even travel together if the dates correspond to each other. We've seen those comments, those von der Leyen comments last week, a bit. Reading through the lines, they seemed a little panicky, if you ask me, towards China. So I guess we'll have a couple of interesting comments coming out of those visits as well. And then there's reports since the whole SVB debacle, we've seen a lot of articles and a lot of scaremongering about what could happen in the credit market, and it shows the Federal Reserve data show like that lending is coming down. The commercial real estate, in particular, credit market is tightening. So we need to keep a close eye on that one, because if there are really spillovers from what happened in the banking sector into the credit market, we could see markets catching a bit of a cold on the back of it. What do you think, Stel, on that front?
Yeah, it's there's a lot of things happening overnight, you know, I think oil is the big story, like you mentioned before, and the inflationary effects that's going to have. I was reading, I actually I had to step off for 1 minute, so I don't know if you mentioned it about Japan buying Russian oil.
Yeah, I mentioned
Yeah, okay. I might have missed that. But bottom line, there's a lot of demand for oil. It's very tight. It's going to be inflationary, and we've passed the quarter end. So theoretically, risk should be dropping today, and it's not. I wrote that on the chat room earlier today. I'm very surprised. So you know, it's difficult to make anything of today's price action, at least until the US come in. But you know, if I was short risk, I'd be very worried here, because really we have now this. Sorry?
If you were short risk.
If I was short risk, I'd be worried,
okay.
because it makes sense for everything to. We have two reasons why risk should be selling off, and it's not. That's my worry.
Yeah, because as you say, the oil price rise is definitely inflationary.
Yes.
And if we think a step further in that, it could hold back central banks from feeling a little bit more relaxed about the inflation coming off, and some of them have already hinted at pausing, and perhaps even starting to look at the other side. Most of them are really data dependent, right? But the hints were there that they might start to look at least pausing or easing off a little bit. But this is not going to help the central bank picture at all, right?
Yeah, absolutely right. But we have to remember, central banks are more reactionary than anticipating things, but they are going to make a note of this, you know, of oil prices going higher. And even, you know, if we see natural gas prices going higher, yes, we're past the winter, but if we see that aspect also rising, then, you know, the price of energy overall is going to be going higher. And we've said it so many times, it takes energy to make everything. So this is going to be inflationary. What will central banks do? I think they're going to wait to see what happens with inflation, which means that we're going to have to wait for 2 or 3 months to see the effect of this. You know, if we do have a sustained move higher in oil, but overall, in the short term, as I said before, I would be very worried if I was short risk, because it makes sense to be short risk, and risk is not selling off. And you know, I wrote on the chat room, I think 4,200 is coming up next in the S&P, and it doesn't make sense, but I think it's coming. So,
well, yeah, I think with your analysis there is correct, but I also think the market is very, very firmly believing, and it could have been end of quarter, but we've already seen risk going up last week, right? And I think the market is really preparing some seasonal effects, because April is traditionally a really good month for risk, and so there's going to be forces pushing and pulling this first week of April, and even going into the rest of April, because there's a lot going on different fronts at the same time. So I guess that somewhere the market is preparing for the seasonals. I think it's 17 out of 21 times that the equity markets have risen in the past years in April. So really, that force could just push people into being long risk, and then as I've already mentioned once in the chat room, it could last for a week or two, and then all of a sudden reverse, right? So I think April is going to be an interesting, if not volatile, month personally.
Yeah. The other thing I wanted to ask is to add is that we have to remember that FOMO is a very strong, powerful force, and that applies to individuals as well as institutionals. And if it looks like the banking situation in the US is contained and central banks, okay, well, yes, oil is rising, but in general, inflation seems to be dropping, easing off slowly. Central banks perhaps getting really close to pausing. What does that all mean? Well, equities go higher. So you're going to see, I think, if we keep grinding a little bit higher, I think we're going to see a little bit of FOMO from pretty much everywhere, because there has been over the past year outflows from equity ETFs and equities in general. So there is cash waiting around, and FOMO is a strong force, and I think we might see some effect of that. And like you very correctly said, April is traditionally and seasonally very strong month. So man, we could see a big old squeeze. It's dangerous.
Yeah, and as you say, I mean, we just can't rule it out, because as Michael says there, traders are following seasonals, and right or wrong, but it does mean that there will be flows that way as well, right? So and some may even be short and say like, okay, 4,100 or so in the S&Ps should be toppish. But if we go through, I need to buy them back. So you just will have flows deriving from it, and as you say, this could be at least the start of the month could be a bit explosive.
Yeah.
But there's a lot to happen. Yeah.
I was going to say, remember CTA's record short for a number of years. We go back to 2016, I think, to find these levels of short position CTAs in the S&P. So I think if the S&P gets above 4,200, I think they start covering. It's just a chain reaction. I'm, as I said before, I would be very scared of being short S&P and equities in general, because it makes a lot of sense and it's not going lower.
Yeah, and the thing is, if you want to pick tops, be careful, right? Counter traders, it can work, but you have to let the initial trade work out first before you can start to counter trade, because it could be a very dangerous month, right? At least the start of it. So let's get back to what happened then on Friday. A bit of you see my data screen, right? The calendar, right? I hope. Yeah. Okay.
Yes.
Okie dokie. So had a bit of how should I say, a bit of a mixed bag coming out on the data front out of the US on Friday. We've seen this. Well, a little bit weaker, but then the personal income was revisions included pretty okay. Then we had the Chicago PMI beating slightly, but then we had the final Michigan actually underwhelming quite a bit, especially if we look at the setback from the past month. That was a pretty sizable setback. And also we're seeing the medium-term, the short-term inflation expectations coming back quite rapidly. I guess that's been undone by this oil decision over the weekend. This thing may reverse actually the next time. But anyway, it was actually a pretty good sign, although the longer end remains a bit more sticky. But anyway, the flows that we had on Friday again were quarter end, and me too. I thought we would come in this morning perhaps a little bit lower in risk, because we've seen this rush up for the end of the quarter. We'll have a look at the S&P, and but yeah, today it's still. Where are we? We're still around 4,100, right? So it hasn't changed much. So what came out this morning? We had the PMIs. Yeah, it's PMI week. It's manufacturing PMI day today. Most of them, the Aussie was slightly better than expected, but still below 50. Irish one okay, but the Irish is a dynamic economy, so that dropped again below 50. The Japanese a little bit better, but still below the 50 mark. What else did we have? We have the Spanish CPI came in quite a bit better. Italian manufacturing PMI also a bit better. And then the final PMIs here were a bit of a mixed bag in the Eurozone. Oh, congratulations, Stelios! Your guys' PMI is quite a bit high.
That's my wife. No.
Oh yeah.
Oh no, that's PMI. It's not retail sales. Sorry.
Yeah. But I mean, it has an impact on the PMIs, right? If you're
Yeah, true. No, she's really nice. She's very
a
very
lot of
thoughtful.
orders, the producers will be happy, right?
Yeah.
Right. But yeah, I mean, they came in some better, some others a little weaker, like the French. But let's say no big shockers. If you take the pan-European manufacturing PMI came out slightly better than what the flash was, but still well below 50. So we can't really call victory on this one. Sterling, the UK PMI just a tad lower than the flash estimates, but again still staying below 50. Not out of the woods yet. We had pretty decent Australian building approvals in there. They were positive, where a negative number was expected. Home loans a little bit less bad than expected as well. Right. Oh, and we had the Aussie retail sales. Yeah, around flattish. But then I don't think that they are inflation adjusted. So with an inflation running at around, what is it, 6.7, 6.9%, that you put that in the frame, it doesn't look fantastic either. The tanker in Japan, not going to read too much into it, but those numbers are still okay, still positive, but it's still not really to write home about. Sorry about that. And that's about it for what we had so far. Now the rest of the week will also be marked by those. The rest of the PMIs coming out later today. We've got the dollar, the US manufacturing PMI, the ISM manufacturing PMIs as well. They are usually pretty well scrutinized. I just have to see, is this ISM also final? Because I don't really see it. I know the S&P Global is the final reading, but ISM, I'm not really sure whether it's the final one. No, it doesn't say on my calendar. Okay. Right, so that's for today. Then tomorrow, of course, we are going to have two central bank decisions, one Australia tomorrow, and that's really one where it could go anyway. A little over half the expectations are for them to keep their hands still this time, and perhaps raise again afterwards, the meeting after that one. But then there is enough of a case to make for them to hike a little bit. So it could really be them going somewhere in between hikes. You know, they could actually do a 0.15 or so to take it to 3.75%. It's just possible. But let's see. I don't have too much of a view on what the RBA can do right now, or too strong a view on what they can do right now. And then the next day we will have the RBNZ decision. That's a bit more clear around the 25 BP mark, but RBNZ has been changing tack a good few times over the past months, quarters, going from yeah, we have to continue to we are done, and then no, we have to continue again. So it's there. It could be more a case of what they say than what they actually do for the RBNZ on Wednesday early morning for us. And then we are going into the next round of PMIs. We are going to have the services PMI coming out on both sides of the Atlantic and elsewhere. And then we are slowly moving into the end of that week, where we are going into the Easter holidays. And so we are going to have some of the oh, do we have on well, yeah, we have the ADP then on Wednesday, of course, out of the US. That's going to be some form of indicator, but we know that the ADP and the NFPs are not really in line with each other very often. And then we have the Challenger job cuts on Thursday, initial jobless claims. We're going to have the Canadian. They are clever people. We are going to have the Canadian jobs report on Thursday. At least that's going to be a tradable one. And then this one. This is crazy. This is really crazy. I don't know who decided to bring those out on Good Friday, but I mean, look at that. The whole world is virtually off. Most of those countries, they did, even if there are traders around, they are going to be like skeleton teams. And yet we are going to have the non-farm payrolls out on Friday. That's really going to be
exciting.
Yeah, you say exciting. It's probably going to be just a lottery. And knowing that, it's such an important domino for what the central banks, for what the Fed is looking at. I mean, and to me as well, it's a big domino, because if it starts to falter, the Fed is going to be pretty quick in reacting, because that means that all their tightening has really started to have an effect on the imbalances in the jobs market. So it's important, right? It's so important, and I think it could be a horrible move with very low liquidity. And as retail traders, we have to be careful about that, because I suspect that the liquidity providers will also be very defensive going into Friday, with a lot of markets for them to cover their positions out as well. So they are we might end up having like very wide prices on that Friday. So be very careful with the positions that you have going into Friday. Right, that for the data. Stelios, would you like to mention anything else before I move back to some price action?
Not really. I just want to mention when I was a trader in London, I always worked between Christmas and New Year's. So a time when, just like now, right, on Friday, when some markets are closed, very illiquid times. Some of the best trades I ever did were on those days. So I think Case is right. We have to be very careful when we're on the retail side, because our liquidity is going to be low. Our spreads are going to be huge. And so take extra care. And by the way, I can, when you're done with whatever you want to show, I'll take the screen and I can show a few things. And I think we're going to have Grega tomorrow join us.
Yeah, tomorrow we have a special guest star at the start of this April, with a lot of seasonals, with a lot of stuff to happen. New quarter. I think it's a good idea that Grega comes and shows us what he will be looking at for the upcoming weeks. It's going to be very interesting tomorrow. So we are going to, Stelios and I, we are going to try and keep it as short and sweet as possible tomorrow for the roundup of what's happening. Perhaps show a couple of big movers overnight, and then we'll pass the screen to Grega to give us his expert view on what's happening on the Elliott Wave side. He's our Elliott Wave doctor, head surfer in chief. I'm just looking at Rob Hansen. Do you believe Aussie Cat UK will save bailout, extend mortgages that need to reset refi higher? It appears this is a real issue that not many are talking about. And I'm gonna have to reread that question. Do you see that question as well, Stel, from Rob? In the Q&A, in the Q&A.
Yeah. Let me have a look.
Save bailout, extend mortgages. I don't think that's the plan, but the plans are, if you look at everything that happened in the banking sector and the risks that may derive from it. I've already been saying that, but I'll repeat it here for because I think it's related to what you're asking, Rob. I think we are on our way to revisions of a lot of regulatory supervision. Not only, not especially much tighter rules, but the supervision of everything. They can't not do it, right? So they with everything that happened, and especially with the Credit Suisse, because we can't forget that Credit Suisse was one of the systemic important banks. We are going to see a lot of regulatory revisions. I don't know if you have anything else to add to that, Stelios, but I think that's
yeah, no, I agree. I just want to answer the question specifically.
Yeah.
You know, when you have mortgages that are resetting, and obviously the rate now is going to be a lot higher than before, you know, that's part of life. That's why you get real estate prices dropping and then rising and then dropping and rising. So this is one of the reasons why real estate starts to drop, especially in the US and you know, some, you know, the UK as well. You know, you get a negative trend. I mean, that's part of the ups and downs of housing. So I don't see why anybody should step in to defend and bail out mortgage holders. You know, there's going to be more supply because of mortgages going higher, and that means prices going lower. And then at some point that's going to stop, and then prices are going to be going higher. So I think it's just a part of the cycle. I don't think there's any reason for rescuing mortgage holders, because then you create a precedent. I mean, you know, what the hell are we doing afterwards? You know, is the government going to control everything, the price of everything? I mean, it's, for me, I don't think anything like that will happen.
No, me neither. It's just the way that that markets move, right?
Yeah, and people, when they take mortgages, you know, you take a risk. You take an interest rate risk.
Absolutely.
I remember when I took a mortgage to buy a flat in London back in 2004. I took a 50% mortgage, 50% cash, and I was scared. And I had the colleagues who were getting 100% mortgages, or even 110. You know, they give you extra money to fix the place up. And I was like, how can you sleep at night? Well, they said, it's fine. You know, people take risk. If it doesn't work out, you bear the consequences. Anyway, yeah, we seem to be, Rob says, fully agree, we seems to be in a nobody loses anymore world. Well, that can't be happening, you know, with everything. It's happening with some things, but we can't do that. We can't control everything. Anyway, yeah. It's
commercial real estate seems to be the hot topic just now. But again, I mean, if you look at what happened in over the pandemic, and then the working from home schemes. And then we know that people left big cities to go back home because the rents were too expensive and everything. And now all of a sudden commercial real estate goes like all panicky. Is it not exactly the same as what is happening, or what people may wonder in that mortgage market? I mean, it's the same. Those guys, they knew that offices would be, we've been saying it since the working from home schemes, that the commercial real estate and the offices and whatever else were going to struggle unless they find new directions for those spaces. I'm always surprised why the market is so surprised when stuff happens that people have been talking about, right? Still, I mean,
yeah,
it's a bit strange. So anyway,
yeah, okay,
yeah, I know, Gav. I mean, everybody wants a bailout now. Me too. I'd love a bailout. I need to replenish my wine cellar, and the prices are actually ramping higher. Can I get a bailout on my wine? Okay, oil. Boom. WTI. It's relatively, I'd say, straightforward. You have this prior high. We shot above it, and then we came here. We already moved back into this. Call it what do you call it? Triangle or whatever. Could still be a bearish wedge or triangle if you look at the technically at the longer time frame. But I think for now, the zone of resistance or the break zone is relatively straightforward. It's anywhere between 81 and 81.60. Stretch it to this prior high probably. But if it goes back above 82, 82 and a half, then this market could really start to be talking about taking it all the way back up to here around 90, the 90.95 zone where we were before, right? So we have to be pretty careful about what is going on here. You see this prior low here, prior high here, 82, 83, 82, 82, 82. Yeah, there's going to be a lot of eyes on those levels. So in the next between 81 and 82 and a half, I say there's $1.5 where it really should cap, or it's going to go flying. And I think we'll have to wait for what the US wants to do with all of this. We're seeing the dollar losing steam in our morning, a bit as I expected, because there's been some decent buying going on for the end of the quarter, and we usually or very often have a bit of a reset of what happened. And Asia was a bit shocked with these oil prices, and right now we're seeing a bit of a dollar reset. So we're going to have to see really what the US is doing. I don't think that the European time zone really knows what to do with it. Sterling is behaving pretty well. So let's look at what happens elsewhere. Oh yeah, just one thing. I wanted to show Brent as well, because Brent is going to be into it, right? We are here in between those two trend lines, and on those this prior traffic zone as well, around the trading around 83 3/4, $84 there as well. Got another $3 I think before its panic stations in Brent, and that's going to be around $87. So keep an eye on that $87 zone. That's going to be the important one topside here, I think. So that for the oils. Gold and silver, not a lot to say. We've had this dollar thing, but then we didn't test even the 1940, which I think is going to be the more important support zone for gold now. And we are already nearly back into this. We are already back into the triangle here, and this bit of a fil rouge. I should put it in red if it's fil rouge. Trend line, which comes in today at around 1970. Still think this 1970s is a bit of a traffic zone where goes above, then we are in for a retest of high 1990s, in my opinion. Stay below, then this zone can come back into play. For the time being, I don't have a lot to say about gold in this zone. Silver testing. Where are we? 23.85 right now. So the red trend line that we were watching originally has broken, but it's always a bit of a double-edged sword. Is it really impulsive? I think we only can confirm if we get back above those prior highs, because since it's a downsloping line, it does tend to lose a little bit of its importance, especially if we start to move out of it sideways. So I'd really wait for the confirmation above 24.5 to really say that that silver is on its way higher. Until then, and if ever we get a setback in risk, can't exclude a move back into the broad 22.5, 22, 23 zone really. If it goes down there and all else relatively equal, I'm going to be very tempted to reload. I'm going to have a quick look at the majors and then I pass it on to you still.
Sure thing. Thank you. Sure thing.
Euro dollar. Euro dollar broke a bit of a support trend line over the end of the quarter, but again, it's quite steep. So yes, broken. Yes, we had the move. Yes, we had the move in Asia as well, bringing it down sub 108. But I think the more important support zone is going to be 55.75, 107, 55.75 is really where I think that euro dollar could be in trouble if we get back down there, but it didn't. In the meantime, we are already back above 108. I am relatively constructive, unless the US decides otherwise, on euro still, because there could still be a bit of divergence because what's happening between the Fed and the ECB. In the meantime, we are already back above this bit of traffic zone here in the 108.30s, and we are trying now to break above 108.45.50 as well. We could be on our way back. I wouldn't exclude it. 108.85 there, but whether we break one on this zone that we tested the last couple of times, this 109.20.60 zone, that's another challenge, I would say. I'm not sure if it has enough strength right now, and let's not forget that higher oil prices, even though the European zone has replenished reserves, higher oil prices should not somewhere be too good for the euro either. But for the time being, the market is shrugging it off. I think a lot is happening already on people trying to trade seasonals, and if stocks go higher, correlation funds will probably sell a few dollars as well. That also should be a little supportive for the euro dollar here. I think we can have a look back at this zone here, 108.85, 109 for a starter, for as long as we hold 108 now. Cable, similar. But if euro sterling doesn't move a lot, cable will probably do relatively similar to the euro dollar. We tried this here, was a little bit of an intermediate support here for me around 122.85, but my main focus is on this one, 122.60.70, went close but couldn't break below, and now we are back already above 123.44, and we are moving back into this ascending wedge. Again, there, if risk is to continue on a positive trend for the start of this month, despite the OPEC oil move, why not? Cable could get back into this 124.05, 45. This is really going to be the zone, right? 124 and call it 40.50. This is really going to be the zone. If ever it breaks above there, why not in the medium term have a look back to 127s? It's been very rangy right for a while, but we have to bear this 124.5 in mind. Really, I really think it's important. If it gets above there, next stop is probably going to be somewhere for a starter in the 126s, and then why not 127? But let's see how things develop. Last one before I pass it on to Stel is dollar yen, and I'll look at other perhaps oil currencies a bit later. People in the room have already seen what I was updating. The longer view says that we are turning around the Ishimoku cloud here. The top side today is 133.43. We've been a bit above, but we stopped on other leading lines there. And the bottom side of it is at 132.5. We've also get the 55 DMA around 132.60 and the 100 DMA at 133.80. So you have your range, and then if you drill down a little bit, you have it there as well. You have the 133.80 figure, which to me is a pretty important resistance zone here in dollar yen, and on the other side, the 132.5 is showing up. So that is really the range that I'm going to monitor for the start of this week, the start of April, we will have to talk, but I want to pass it on to Stelios. I will talk about what's happening in Japan. I will talk about the new fiscal year. I will talk about the Bank of Japan handover from Kuroda to Ueda, what it may mean for the Japanese insurers as well if we start to change the monetary policy. But I'll leave that for afterwards. Yeah, short $CAD, Horatio. $CAD could, let me quickly, because it's directly impacted by oil, right? If you look at this one here, that range that we were in, if you make the extended, if you transpose it here, $CAD could be on its way to 134.30, perhaps even 133.90 figure. But therefore, we have to stay below 134.90.15. 133.90.15 here is going to be the barometer for whether $CAD can continue or whether we see the rebound. That to me is a bit of the pivot level in the short term. Stelios,
sir,
over to you.
I'm taking it. Well, like it or not, I'm taking the screen now.
Yeah, take it, man. Take it away.
Okay, so oil is dominating the news, but I start with yields as I always do, and we have to look how nicely in terms of a technical way yields have been trading, and I think this is a really great example. So we had the lows. Okay, this is a daily chart. I'm just going to go a little bit back, but we have the lows here in August last year to the highs. Nice big impulsive move. So what does that say when we see a reversal? Well, the next really support level is the previous high, which is around June 2022. We get to that point roughly, we bounce, we now have this trend line. Again, we go down roughly towards those lows. So now this becomes a zone, and then we come here and then we break out. So, as soon as you see this breakout, there's more coming, as it was. And now, obviously, with the Fed kind of slowing down a lot and the banking crisis, we're coming back here. We are trapped in yields between two very important levels. The high, I think, is this. There's a fib and there's a 50 DMA. I think 370 is the level above which I think we're going to go towards 4% again. And the lows is basically this zone here. So it's very nicely laid out technically. And I really liked how this traded over the past year or so, or 9 months. But at the moment, we're in no man's land. So not much to say about yields today, but I really liked the price action over the last months. Oil obviously is a big factor in terms of inflation. So theoretically, oil rising should have a positive effect on yields. And we're seeing 10-year up 1% today. But again, we're just going sideways, trapped between these two DMAs, and nothing really major happening there yet. The S&P, we have one of our friends who I think they've left, but they were talking about, it's a doji today. What do we think? Is this a reversal? Well, I'm not going to do anything until I see the close of this candle. It looks like a very short indecision candle today at the moment, but the day's still young. So I wouldn't say anything about this. What I'm going to say, though, is that we are seeing extreme resilience in equities. And as we said before, it makes a lot of sense on a macro level to be short equities, but they're not dropping. So I think 4,200 is coming up. And man, if this gets broken to the upside, I think then there are going to be more forces, more short covering. You can bet there's going to be people shorting this against the 4,200 highs. It is a nice risk reward short, but if this thing goes straight through, I really don't know what the next level is. Probably something like 4,500, but let's not get ahead of ourselves. Equities are very strong, and I will not get ahead of them and try to short them. I really, really will not. Yes.
What has to break on the downside to say the party is over? I'm not saying it will happen. I'm just a question. What has to break to say that's it, the party is over? 4K, or is it even lower?
That is a good question. I would probably say somewhere this region here. So 39, somewhere between 39.20 and 39.40. We had a few lows there. We have the DMA, which is going to be, if we start edging lower, that's going to be converging. I would say 39.20 to 39.40. That's my area of interest. So we have some way to go until we can say that, okay, this is now starting to look weak. Let me get rid of this because that's not going to get there now.
Michael is asking the question, huge NFP numbers will break equities. I don't think so.
Huge NFP numbers will do what?
Break equities. I don't think so. You can have an initial setback on higher yields because they will take the yields higher. But and I know how correlation traders want to work. But if you have a really good job market, why would stocks go down?
Yeah, the argument is that the very good jobs market means the Fed needs to keep going.
I know.
But it's not really jobs. I mean, the main factor that drove the Fed to be hiking like crazy was inflation. Jobs has been pretty steady over the past few years, couple of years, right? After COVID. So
very good, actually.
Yeah, exactly. Pretty steady and pretty good. So
which is supportive for an asset in the country, right?
Yeah.
Somewhere, if you look at it from a fundamental point of view.
Yeah. Anyway, so yeah, I wouldn't really get ahead of this. I mean, it's a good risk reward short at 4,200 or close to, but everybody can see that. Again, that's a problem for me. When something is really obvious, I don't usually touch it. So to our friend Michael, who's asking about metals. With inflation creeping lower, that theoretically is good for metals because that means the Fed has to stop hiking sooner and stay at these levels for a shorter period before potentially they start cutting. So theoretically, this is good for metals. What we have to acknowledge is that over the past, let me scroll back a little bit here weekly. So over the past year and a half, what have we had? We've had spike in inflation, big hikes from pretty much every major central bank. What has gold done? Just consolidated sideways. I mean, and actually it's a lot closer to the all-time highs than it is to anywhere near this the low of this range. So it's traded really well. Yes, gold is theoretically an inflation hedge. Actually, not theoretically, it is an inflation hedge, but perversely, when the moves are happening, when the rate moves are happening, and where the market's pricing hikes and tightening, that's negative for metals, pretty much always. If you go back to, let's have a look at 2008. So this is when 2008 was kicking off. Gold went from 900 and something to 680. So that was percentage-wise pretty old drop, but then the market realizes that it's going to be low rates for a long time, and then it just flies. So I would have expected, if you had told me that the Fed's going to be going from 0% to 5% within a year and a half, I would have said to you, yeah, gold is going to be breaking below 1680. It did break below, and it actually was a false breakdown. So, and I would have said, I think gold's going to be there now, 1600, something like that, because that's the immediate reaction of the market. Well, this has all been priced into the market. This all happened, and gold is doing really well. So when that starts reversing, I think the breakout higher is it's almost a given. The question is, how do you trade it? And the same thing applies with silver. And you know me, I got long at 21 and a half roughly. I got out of half the position just below these levels a couple of late last week. This is a very, very important resistance. Am I bullish? Of course I am, very bullish. But do I think we could get a pullback towards the low 22s? Yeah, absolutely. And if we get good jobs report or a good inflation print, metals always overreact, always, especially to the downside. So I am being very cautious. If this breaks to the upside, and we have said this so many times, you guys are probably bored of hearing this, but a break above the highs, 24.50, maybe 24.55 on a daily basis, I'm buying back what I sold at 23.80. And I know it's going to be 70 cents lost, but the rest of my position is still from 21 and a half. So a breakout higher would do very nicely indeed. you have to be nimble. We're not yet, I don't think, in a trending market. There's going to be a lot of chop in pretty much everything. So you have to be nimble. You have to get in and out. And sometimes you get it right, sometimes you get it wrong. But the main thing for me is when a trade is going well, and let's face it, 10% in a month and a half is not too bad. You have to take some profits, and you have to trade around your position. At least that's how I do it. So oil we were looking at before. Oops, no, oil. I remember I was saying it looked like oil had been breaking. Well, it was breaking below this wedgie thing. And I was saying I would love to see a retest to sell that. That happened on Friday. The market was really strong. And I didn't do anything. I was saying, well, let's wait for Monday. And Monday, obviously over the weekend, we had the news, and we've rallied back above. Interestingly, we've come right up against this trend line resistance, and we come back down. Now, what do we do with oil here? It is torn on a fundamental basis, torn between two major forces. One is the potential of a recession coming and demand destruction because of that. But on the other hand, when supply gets constrained, if it gets constrained more than the supply, more than the demand drops, then price still goes higher. So it's been pulled by those two forces, and I'm finding it very hard to decide what I want to do with this now. So I am neutral, and I'm not touching it at the moment. It's too big, too much of a widow maker at the moment. This thing.
Still,
yeah.
I wonder if some smart cookies somewhere, if you look at the move over the past week, were already a bit close to the decision makers, what they were going to do, because it really pulled up out of nowhere. We really had a big rally already up to those mid 70s, right?
Yeah.
Yeah, but anyway, as you say, I mean, it's going to be important to see, and I think, I mean, the biggest market participants, at least trading it, will probably enter the market in about in a couple of hours, right?
Yes. Well, let's see. Currency wise, I was looking at cable. Nice little structure here, which we have rejected again. So yeah, it depends on the dollar quite a bit now. It depends on what we're going to get in payrolls, but this looks to be a nice little rejection here. So, if you want to be short this, where you're wrong. Anywhere above 24, 15, 20, let's say. I think that's a technical signal that you should be getting out. But nice little reversal. And but I think this is more driven by the dollar than anything else, and the dollar is at a very important area. It's been going pretty much sideways for the most of this year. Yes, we had a little rally and then really sell off, but really this is consolidation. So I really haven't decided about the dollar. If you put a gun to my head, I want to sell it, but I don't want to sell it at these levels. I probably want to see a dip in the euro dollar, or the pound. Yeah, if we maybe a breakout above this range that we were showing here, a breakout above, I think that would be a nice technical break that I would probably try to follow higher. And the euro, again, it's not really convincing. And I mean, we have to break above 110.30, kind of in no man's land again. We're just data dependent now. We're going to see what happens with with payrolls, with PMIs. There's a lot of stuff happening, a lot of stuff coming. Cryptos look bullish to me, I have to say. And if equities cannot gather any downward momentum, I think Bitcoin is going higher. Don't ask me about fundamentals. I don't, it's very difficult for me to talk on fundamentals about crypto. So I'm just going to look at the technicals. And this is a very, very, it's an important, it's a fib, 23.6 fib of this big move lower. And we paused there on the way down. We're pausing on the way up, and this looks like a very nice, flag, or whatever you want to call it, some kind of bullish consolidation. So if equities go higher, I think Bitcoin is going towards well, somewhere between 33 and 35K. So that's percentage-wise, that's going to be a nice little move. Okay, we've been going for about an hour. Let's leave it at that, and then we look at more stuff tomorrow.
Exactly. Thank you very much, still, for all of that. Thanks everybody for your for coming to our show. Have a great April. Trade safely, and we'll talk again tomorrow.